Okay, folks, if we can get settled, we can start. I'm sorry that bad pennies have a habit of appearing again and again. So I'm here again in front of you, second time of the day, but that's what it is. So this paper is Man versus Machine, and we're looking at liquidity provision in the context of market fragility, and this is joint with Vikas Raman, who is a former doctoral student of mine and who's now assistant professor at the University of Warwick, and Michelle Robe at American University and CFTC. Some of the context is there in relation to what we were discussing this morning. Equity markets today are largely order matching markets, and the liquidity arises entirely voluntarily from the standing buy and sell limit orders, which are posted by different market traders. We don't have any affirmative obligations, as used to be in the era of specialists on the New York Stock Exchange or the London Stock Exchange market makers. In the context of the fact that the provision of liquidity is entirely voluntary, an important area of concern for exchange event regulators has been to ensure that liquidity is available continually and reliably at any time, so that there are always standing limit orders to execute against in good times and in bad. And as Venki pointed out earlier on, this concern is now focused very strongly on algo traders because of the very significant increasing proportion of liquidity which is supplied by them and the perception that they run for the gates at the first sign of trouble. So in this paper, what we do is to investigate the participation and the liquidity in transactions provided by the algo traders, voluntary algo traders, relative to voluntary human traders. And we focus on periods of market turbulence and stress, and rather than in normal periods. Of course, we compare with normal periods, and we then make inferences for the fragility of these markets. So we ask that question: what is the propensity to stop providing liquidity when the going gets tough? And how do the machine traders fare relative to the human traders? And we use data from the National Stock Exchange of India, NSE, and we are very grateful to the chairman and his organization for that purpose. This is a market in which liquidity has always come from voluntary liquidity suppliers, and a market which has always been an electronic order matching market. So what should we expect? Now, what we should expect is that algo traders should have a competitive advantage over humans during periods of high levels of information asymmetry, information intensity, information flow, whatever way you might want to characterize it, information intensive periods. First, they have an obvious speed advantage. So we have a paper by B.A., Foucault, and others, which shows how traders face adverse selection cost relative to algo traders, and they should. We know that algo traders are not constrained by the limits to human cognition, which arise when you access and process data across fragmented markets. And the data availability today is much, much better than it used to be. Also across related assets. So once again, that should mean that algo traders should have a competitive advantage on others. And this is consistent with the fact that Brogard and other papers have shown that algos lead with respect to price discovery and impound more information than human orders, and that's the perception we have today. However, all these analyses relate to the periods in which everything is hunky-dory, everything is going well. Now, what happens in periods which are stress periods, or periods which are extreme periods from a stress perspective? If it is indeed true that algos enjoy a competitive advantage over humans in turbulent times, then it should be the human rather than the algo liquidity suppliers who should be the ones withdrawing from the market in tough times because they can't deal with that toughness. What do we actually have? That's what we look at in this paper. Now, on the other hand, one can argue that there are good reasons for the withdrawal of algos, and one of the biggest reasons is complexity. So data and hard releases of news is not information. They have to be processed into usable information. So algos have an advantage in as much as they are processing it automatically. However, they have an advantage with this when it comes to hard data. So if you want to fly a plane, you are dealing with exact sciences. You know exactly what you expect with a certain degree of pressure and certain degree of whatever else goes on which drives it. So you can have all these planes flying on autopilot. However, when you are looking at an economic world, processing data in this world is complex, it's imperfect, it's subjective, it's uncertain, and involves a lot of soft components. And hence, BA and others come up with a term which they call preference uncertainty, which says, well, in the economic world, processing data into information is far from perfect. And the question arises, can algos be pre-programmed to address the entire spectrum of preference uncertainties and complexities? Now, in this context, the United Kingdom had a foresight exercise, and they spent millions of pounds in that, in researching what happens in relation to algorithmic trading. And they have a set of billion studies, which are not really academic studies, but they are very good studies of surveys, and they are very, very solid. And one of them is a survey study by Beyonce, which says that, no, algos tend to be very simple. The algos in the real world are very straightforward, simple algos. They are not really complex, programmed for various kinds of uncertainties. So you would expect that complexity should lead to withdrawal of algo traders. Another speed is another issue. What enables algos to exploit price distortions before human traders also limits the time available for processing information. And Dugas and Foucault theorized that this is the cause of many flash crashes. Then, secondly, algos learn from what happens in the past. Now, periods of market stress are rare and unique, and therefore pose severe challenges to algos whose decisions are really based on pre-programmed routines with parameters set ex ante. Now, clearly, though, they are updated and so on, but the past lessons can't be really used in uncertain periods, and therefore, once again, there's uncertainty. There's also a risk of glitches when running new and adapting old algorithms, and we know all about that from the Knight Capital case. And therefore, both the foresight study and suggested that algo traders believe in building systems that deal with the worst case scenarios, and therefore they want to apply a kill switch, shut down activity as soon as the going gets tough. So in turbulent conditions, it's also true most of the algorithmic traders are more disciplined. They have risk management programs, which human traders don't necessarily follow the same discipline. And the discipline of automated risk management algorithms reduces participation liquidity provision at times of stress by simply applying a kill switch. Again, came out of the foresight study. So all of these are reasons for thinking that complexity would result in a greater withdrawal of algos. Now, it's kind of typified by comments like the fact that humans are likely to be the best at reacting to freak situations or unexpected market shocks because algorithms cannot be reprogrammed fast enough. Now, in that context, experimental economic studies, you have Vernon Smith, who got the Nobel Prize in 2002. And in that context, there was a study by a set of researchers from IBM who asked the question, are machines better or humans better in trading in markets? And of course, it was an IBM-based study using an IBM software, and Das et al. Studies quoted quite a lot in the literature found that, machines are much better. Then the foresight study again did another study, and they came to the opposite conclusion. That's DeLuca et al., 2011. Now, those are, again, experimental studies. What we do is to look at actual data and see what we can find. There are other reasons for withdrawal by algos. We have short horizon. We know that algorithmic traders have a very short horizon, work on limited capital, and therefore, if their horizon is very short, and the chances of profitable rebalancing of inventory in that short horizon are small, they would rather be out of the market rather than be in the market. So once again, apply a kill switch. Another is the issue of correlated order flows. It was a point raised by Joshua in the earlier presentation, which was that what about the correlation among, and there is established evidence, a recent Journal of Finance paper, which showed that there is much higher correlation in the trading actions of computers than those in humans. And that was based on empirical evidence. And of course, it makes sense because computers need to be pre-programmed, and because all of us have the same kind of education, we tend to program them similarly. There's another paper which shows exactly the same thing, the highly correlated order flows from algos. So if one withdraws, there's a lot of correlation in other people withdrawing as well. So the correlated order flows also cause the propensity for flash crashes, as was shown in that foresight study in another paper by Zigran et al., which showed that when the people correlate, act in unison, feed on each other, it results in a feedback loop leading to a disproportionate amount of reaction. And the CFTC-ICC report on the flash crash pointed out to the same thing. And then there is also the decoupling from fundamental value, which has been alleged to exist in the context of algorithmic trading. There's the quote I like in that context is, some algorithms know the price of everything and the value of nothing, which is essentially exemplifies the fact that they need to go from data on to value. This is also extensive regulatory concerns, which say, for example, the bottom line conclusion of the foresight report, the executive summary was, algos improve overall liquidity. It also generates greater dangers of periodic episodic illiquidity. And similarly came across a quote from Mary Shapiro, the then chairman of the SEC, in relation to the impact of algos potentially on the stability and integrity of equity markets. Andrew Haldane at the Bank of England once again said HFT liquidity evident in sharply lower peacetime bid-offer spreads. And we know that that's true. The bid-offer spreads have been reduced post-HFTs. Maybe illusory. In wartime, that liquidity disappears. So this is the background of concern on which this paper exists. I'll miss out on a few of these things and talk more about the paper now. So the current empirical research is largely focused on normal market conditions. And our contribution here is to focus on periods of market turbulence and stress. And we, of course, have to define what stress is. We define it in terms of high and persistent volatility, high and persistent order imbalances, high and persistent bid-offer spreads. Of course, one can quibble with that and have alternative measures, but that's what we do in this paper. And we empirically test whether algo participation in trades and liquidity provision is as reliable and stable as that of humans in the times of market stress, or whether complexity and other factors result in algos being essentially just fair weather friends, or fair weather liquidity suppliers. Our results are the following. I'll just summarize them. Buy-side algorithmic traders, I don't mean buyers and sellers, I mean people who are using the market to trade. Rather than the sell side is called, sell side is the side who are supplying intermediation services. So buy side are the market participants who use intermediation services. So buy side algorithmic traders significantly reduce their participation in liquidity provision during periods of market stress. That's a very strong result, unequivocal result. We analyze in several different ways. We do a simple univariate. We also do other we take different categories of traders and do what we in finance we call a difference in difference. And we also compare with a pre-algo period, 2012 versus 2006, and apply all kinds of controls. We also find that buy-side algo traders behave differently from sell-side algo traders. Sell-side algo traders, though voluntary traders, appear to have some more reputational or contractual considerations which make them behave a little differently. And we also find, more interestingly, is that the change in trading behavior corresponds one-to-one with the change in the informational advantage of different algo categories. So buy-side traders suffer the most in terms of informational advantage during stressful times, and sell-side traders suffer the least, supporting the complexity hypothesis. And we find a similar case in the case of the order book. All categories of voluntary automated traders withdraw from the order book significantly more than their manual peers during market conditions. So the question is, do these people run away, or do they just increase the size of their spreads in order to deal with a stressful period? And the answer is they do both. They run away as well, and they also increase the cost of providing liquidity to a greater extent than manual traders at the time in stressful times. We also find that the role of algos in terms of participation liquidity provision increases the probability of an extreme event in the next 5-minute interval. And that is why market fragility comes in. So it is not just that they withdraw, period. It's not just that. It is they withdraw, and that withdrawal causes the market to be more fragile in the following period. And that fragility extends not just to that stock, but also extends to related stocks. So we find that algos withdraw significantly even when any of the other stocks in the Nifty 50 have experienced an extreme event. So that's our data. I'm going to not talk too much about the data given time. Essentially, we have 3 trader categories. Client 1 and Client 3 are customers of the exchange, except that Client 3 are more sophisticated customers of the exchange in as much as they employ their own clearing member, while Client 2 are essentially members of the exchange and what we are calling the sell side. And as I said, we use 1 month in 2006, 1 month in 2012, and we use the Nifty, 50 stocks in the Nifty. And we study algo trading and provision in normal extreme periods, and we examine participation, that is the proportion of trading volume that involves an algorithmic trade rather than the buy side or the sell side. And we study liquidity provision, which is the proportion of trading volume for which algorithmic traders provide liquidity, and which is based on the fact whether they posted a standing limit order that got picked in a trade. So liquidity provision is defined as posting a standing limit order which got picked in the trade. Now, Nidhi did a great job in presenting details of what the NSE looks like, so I'm going to skip these slides and go on straight on to other things. We define an extreme period based on 5-minute interval. So 5-minute interval is classified extreme when the 5-minute volatility and the 5-minute spread and or the 5-minute opposite order imbalance over the past 1 hour has on average been greater than 2 standard deviations away from the mean. So if you take a normal distribution, a 5% chance, there's a 5% chance of a greater than 2 standard deviation away in one interval. What we want is greater than 2 standard deviations over 12 successive intervals. So we're looking at persistent stress. And therefore, the chance of that rare an event is obviously much less. So it's generally a rare event. And we use the trader category provided in the data set to conduct a difference in difference analysis. Suppose client 1, algo trader, provides X1% liquidity during normal times and X2% in extreme times. And client 1, manual trader, provides Y1% liquidity during normal times and Y2 in extreme times. Then the effect of automation on liquidity provision is measured as X1 minus X2 minus Y1 minus Y2. So that's the difference in difference approach. First, looking at overall numbers. As you can see, we have market extreme conditions, normal conditions, so there is no categorization difference with different trader categories. And we're looking at extreme based on just volatility, extreme based on just spreads, extreme based on just absolute order imbalance, or extreme based on any of these 3. So that's what these 4 categories are. And in each of these cases, you can see there is a huge drop in algo participation at the time of the extreme periods. So overall algo participation liquidity provision drops about 25% for all types of extreme conditions. Then we, as I said, compare algos with two groups of voluntary traders. We first compare algos with manual voluntary traders of 2012 in the same trader category. And then we compare with manual traders of 2006 of the same trader category. So that's the two benchmark samples we use to make the comparison of whether voluntary traders, algorithmic traders withdraw more or less. And then we do a difference in difference analysis of that difference. So the first one we have with respect to manual traders of the same trader category in the same period. So we are looking at the same period, May 2012. And we find the results completely confirmed. Algorithmic traders withdraw significantly more than their manual periods during periods of market stress. And there is also a difference between the buy side and the sell side. So when we do something like this, where this is trader category 1, trader category 3, trader category 2, and this is algo trading, and this is manual trading. So we look at algo trading between normal and extreme periods. The fall is 21% to 12%, so minus 9%. For manual, the fall is less, and so we take a difference here, and we similarly take a difference for the other two. And clearly, that difference in difference is what is the basis of our inference. And though all the three withdraw, the withdrawal is much greater in these three categories and relatively less in the category of the exchange members or the sell side folks. Yeah, I'll try and find out. It'll probably take me 5 minutes. Then we compare with the different trader categories from 2006, and therefore we are the manual trader category 2006. So we compare the algo traders with them, and we find a result which is exactly the same. So virtually exactly the same, no difference in results. And given that I don't want the chairman to stand next to me, I'm going to be quick. We then go about and doing a multivariate analysis, which puts all of these things in a regression, has controls, and we find that, and I'm going to just talk about the results rather than put the tables up. For volatility-based extreme events, participation decreases, but increases when volatility when it is very high. So that is because, and then when we try and parse it out, we find that is because of the fact that they start demanding liquidity when the going gets tough. The participation with respect to spreads is only the withdrawal arises only when the spreads are very large, and absolute order imbalance, again, we find that the withdrawal is very high and significant. So let me skip these slides. Then the question arises, if the reduction in algorithmic trades during extreme conditions because of their withdrawal from the order book, or is it due to the algorithmic traders posting relatively more passive orders and therefore not really being able to make the trades? And so is it a withdrawal from liquidity provision or an increase in the cost of liquidity provision? So therefore that we have to examine the order book. And we find that, once again, we measure limit order activity as a proportion of the number and volume of new orders submitted by algo traders and the proportion of and volume of net new orders. And we'll also look at the change in the cost of liquidity provision as measured by the change in the aggressiveness of the new algorithmic and manual orders that are submitted during periods of market stress. And we find that the proportion of algo new orders and net new orders, both number and volume, drop very significantly during extreme market conditions. And overall, if you look at the whole thing, we don't see a change in the pricing aggressiveness. However, when we do a difference in difference analysis, then we see, then we are able to parse out the difference. And we find that all categories of algorithmic traders withdraw significantly more than their manual counterparts. And to give you an idea of magnitudes, category 1 algorithmic traders, the proportion of new orders and net new orders drops dramatically by 6 or 11 percentage points, which is about 8 or 6 times the corresponding variable for manual traders. And similarly for the other measure that we have. So we also find that even exchange members also, while they withdraw the least, but they also withdraw very significantly more than their manual peers. So all in all, virtually all algorithmic traders, irrespective of their type, withdraw. And more than that, when we look at the change in pricing aggressiveness, we find that the category 1 and 3 algorithmic traders that remain in the marketplace are significantly less aggressive than their manual peers in stressful conditions. So that's why they will not be seen so much in the trades, and that trade withdrawal will appear. So it acts both ways. However, the exchange members are better in as much as there's no significant change in their relative aggressiveness. So all categories of voluntary automated traders withdraw from the order book significantly more than the manual peers, and with the exception of exchange members, also place orders that are significantly less aggressive than orders of the corresponding manual traders. Bottom line, they withdraw, and the question is, why do they do so? So let me just look at one factor, complexity. And for that, we look at the persistence. So we say, okay, we did the original analysis based on whether the stress was persistent for 60 minutes. Suppose we look at only 30 minutes, or 15 minutes, or 5 minutes, and we find that the withdrawal increases as we increase the time period. So as we increase the time, when we look at 5 minutes, there's no withdrawal. When you look at 15 minutes, this withdrawal starts, but it's smaller. And it keeps increasing as we go along. So the persistence of disturbance is an important factor, and which suggests to us that that's consistent with complexity-driven withdrawal rather than short horizon-related withdrawal. That we intend to analyze this to a greater extent. Then the next thing we look at is informativeness during that period. So what is the extent of informativeness of the order, and we measure that by the 5-minute price change. I won't go into how we measure it. Suffice it to say that in extreme conditions, in normal conditions, algos, which is number 1, which is category 1, are informed in the sense they make money from their trading, while non-algos don't. While in the extreme conditions, algos stop making money from there, in fact lose money, and the other manual traders make money. So the algos who are significantly more informed in normal conditions lose their competitive advantage during extreme conditions. Manual traders are significantly more informed during extreme market conditions. And so once again, the evidence is consistent with the complexity hypothesis. Algos struggle to respond to a non-familiar situation. And let me say that we do a difference that's supported. And if we analyze across categories, client 1 algos lose the most, and client 2 algos perform the best. So the change in informativeness and change in participation once again supports the fact, since it's one-to-one corresponding, supports the complexity story for withdrawal. Then the question next we look at is, how does this affect liquidity provision? How does a withdrawal affect liquidity provision in the following period, which speaks to market fragility? Is there a vicious circle of algo withdrawal and extreme events which would destabilize markets? And we, without going into how we do it, our results show across the board algo withdrawal from trading significantly increase the probability of observing an extreme event in the following period. We do logit models, etc. here. And to give you an idea of numbers, a 1 standard deviation decrease in participation increased the odds of an extreme event in the following period by at least 28%. And a 1 standard deviation decrease in liquidity provision increased the odds of an extreme event by at least 30%. We also look at how related stocks are impacted. That's contagion analysis. So in a 5-minute interval, if there is an extreme event for stock I, what happens to stock J? And we find, again, that algo participation liquidity provision drops significantly for all types of extreme conditions for related stocks as well. So there are a lot of limitations that we need to do this. We want to do this finish this very quickly, but it's a huge data set, takes time, and we need to do some other stuff. So we need to tease out other reasons for withdrawal, short horizon, correlated trading, and fundamental value decoupling. We need to do some endogenity-related controls. We have done some. I haven't had the time to discuss it. We probably need to integrate with futures markets, and so there are some other things which we will consider. The bottom line is, there is the fact that algos withdraw much more than manual is unequivocally borne out. And the fact it also corresponds with informativeness, change in informativeness. It also leads to fragility in as much as it causes the greater stress in the following period. Thank you.
My name is Ramon Kumar. I'm from Virginia Tech. Last time I was discussant on a paper. The presenter did not show up, so I had to present the paper as well as discuss it. This happened at ISB Hyderabad. So I was hoping today that doesn't happen again. But thank you for being here, Pradeep. Yeah. And then after I finished discussion, somebody said, can you give the response to the discussant also? So in the last 2-3 weeks, I've traveled twice to US, so I'm still under jet lag. So if I misspeak, possibly could be because of my jet lag. But anyway, I really enjoyed reading the paper. I read it going back to US as well as then coming back from US to Bombay. And I've always been intrigued by this question, and my hunch is in the direction of your results, that these algorithmic traders provide liquidity when the liquidity is good, and they take away they withdraw when you really need liquidity. And it's all of the hypothesis, the way you build it up, the way you execute the study, it clearly is very well done, and it has obvious regulatory as well as academic implications. And your finding is that algorithmic traders significantly reduce their participation and liquidity provision under extreme condition. And this reinforces the regulatory concerns that people have for algorithmic trading. It's a well-executed study, do univariate analysis, diff and diff, both across normal conditions, across past periods, multivariate analysis. To my being jet lag, it's not logit modeling of AT, it's logit modeling of extreme conditions, with AT as one of the explanatory variables that drives the extreme conditions. Overall, I like the study. And so one of the problems is if you like the study, you don't have much to talk about as a discussant. So at times, maybe it's better not to have such a well-executed study. But nevertheless, since I'm the discussant, I'm going to make a few comments. Okay. Both whether it's in writing or in presenting, you use the word they run away, they stop trading, they withdraw. But all of your data is on percentage participation. I think what you're saying is right, but show me the volume numbers. If it drops by 8%, but the volume is 50% higher, that does not mean they're running away. Maybe algo participation is increasing in trading, but increasing at a decreasing rate, right? So if the volume is higher during these extreme conditions, the volume doubles or goes up by 30, 40%, and the percentage drops, that's not as big a concern as when it is under low volume. In fact, I'm going to later on suggest one definition of an extreme condition should be periods of very low volume. To me, if they run away in periods of low volume, if the participation is lower when the volume is low, to me, that's the most troubling this thing. And so I'd like to see volume numbers. So basically in tables 3 and 4, when you report percentage participation and liquidity provision, I would like to see what is happening to the trading volume. The other thing has to do with, I'm still struggling with maybe, is there a better way to define extreme conditions? For example, you have 347 observations if you combine any of the three extreme conditions. So whether high volatility is present, whether high order imbalance is present, or high bid-ask spread is present, or plus minus 2 standard deviation, and you come up with a total of 347 observations that are persistent, right? If you look at the three individual groups, 201 in high volatility, 141 in high spreads, 10 in order imbalance, they add up to 352, which means these three extreme conditions are basically mutually exclusive in the way you define them, right? So in that scenario, if you have high volatility, which is 201 of your observations, most of them, in fact 99% of them, don't have any order imbalance or very little order imbalance and don't have high bid-ask spreads. So high volatility with no order imbalance and normal spreads, is it really a stressful condition? It could simply be a day on which there's a lot of new information coming in, but there is no information asymmetry about that information. So good or bad news has come. Everybody agrees what's the value of that information. So the bid-ask spreads remain small, the order imbalance is not there, and the price moves up or moves down depending on whether it's good news or bad news, but no information asymmetry. In that case, is it necessarily a turbulent or a stressful condition when there is new information which people completely agree about, right? So I still agree with the results. I'm not saying this is driving the result, but this is something you maybe need to investigate a little more. So what I would do is I would subdivide the high volatility, which is 201 observations, maybe into three terciles, into return terciles. So high volatility with very high positive returns, high volatility with practically zero returns, and high volatility with negative returns, and see if there are systematic differences across these three groups, these three terciles. This may provide us, if all the three terciles look similar, then you already have the conclusions. If they look different, that will give us additional insight. Similarly, I would divide the high volatility 201 observations into three volume terciles. Days, those 5-minute interval when the volume was very high, when the volume was normal, when the volume was extremely low. If the volume is extremely low and the volatility is extremely high, that's the one that I'm really concerned about. Do they run away during that time? And in fact, I think you may find that the liquidity provision drops the most during that time, which would be even of a bigger regulatory concern. That when volatility is high, volume is low, and they simply vanish from the market, that's when that would be of big concern. So you could get additional insights. I'm not downplaying your results. I like the results. I'm just saying, what could you do to make even further insights? Conclusions, it's a very well thought out, well executed study, and best wishes for its publication. One more thing actually was just occurred while you were presenting. In the logit model, where you have extreme conditions as the dependent variable and algorithmic trading as one of the variables that's driving it, you find persistence of extreme conditions, right? I would see if that relationship survives, putting in a dummy variable for whether the past period was also an extreme condition variable. If the extreme condition is simply coming out of, because the last period was extreme condition, then it may not be AT that's driving it. Just a suggestion. But overall, really enjoyed reading the paper.
Thanks, Ramon. The first comment was in relation to the fact that we should present trading volume in addition to percentage. I think that's very well taken. We clearly have done the analysis also on trading volume. And the results are completely and totally unchanged. It definitely makes sense to present the trading volume results as well in order to make the point. Your second point was on the definition of extreme conditions. And once again, I think I should explain a little bit more here. The extreme conditions are defined as being very rare. So, you have 140 out of 65,000. So, I mean, they're extremely rare. And the fact that there is an extreme condition with respect to volatility, but not an extreme condition with respect to bid-offer spread, does not mean that the bid-offer spread is normal or bid-offer spread is anywhere small or anything of that kind. It has not come into the extremely rarefied space of the truly tail event that we are looking at. So therefore, now when we look at the 30-minute persistence and 15-minute persistence, we have a greater degree of interaction. I don't remember the figure off the top of my head, but we have much more of an interaction in the sense there are more periods where they are common. And of course, that makes sense because there the number of events are they are much more commonality. So perhaps we should look at some of the extreme events and see if there are any which are completely kind of in the opposite direction or normal for the other variables. Then maybe we should take a look at them. But I'd be very surprised if that's the case. It's really the extreme conditions in one may not necessarily lead to an extreme classifier, but they will still be high. And if anything, it will bias our results in the opposite direction. If suppose we have included stuff which are more than what would classify as an extreme condition, then our results would be biased against us, and we still find the results being very strong. So that's number one. Number two, you mentioned about two classifications, return and trading volume, and both of them are excellent suggestions. For returns, we have done it. We have not done for trading volume. So for returns, it makes no difference. So we looked at different category returns, and it makes absolutely no difference. Trading volume, we haven't looked at it, and I think we certainly should. I completely take that on board. And in relation to the logit stuff, which is past being once again, it's extremely rare for that to happen. We don't have consecutive extreme events. They're just not there. Thanks.
I have 1 minute of a comment and it's not a question. So I think everybody's incentives are right. I want us to step back for a moment from the human versus robot question. Let's instead switch to thinking about trades and strategies. Okay, so there are what we may call mechanical rule-based strategies and complex judgment-based strategies. And this is not new to computers. Okay, remember technical analysis was around for many, many, many decades before there was a computer. So there are people who mechanically look at screens, who do mechanical trend following, and who do trades. And there are people who are more subtle. So imagine that the Fed decision came out, and some people see that, wow, there's been a 17% decline in the WIX. This has a profound implication upon capital flows for EMs. This is not the kind of unpleasant surprise that we had expected based on the taper tantrum. So they are doing more fundamental, more judgment-based trades. And there are others who are happy to be trend followers. That, oh, EM currencies are doing well, I'm long EM currencies because I'm just a trend follower. So what I would like to emphasize is that simple mechanistic strategies versus complex judgment-based strategies are as old as mankind. Now, for the first time, we have clerks, algorithms, who are able to roll out some of these simple mechanical strategies, and we observe them for the first time. And we make a mistake when we think that this is something new in this market structure, that the automation of markets has somehow created a new kind of trader who uses simplistic strategies. My thought is that if you go back before algorithmic trading, there were simple people and there were sophisticated people. And I bet that all the same things happened. I think every simplistic guy, so modulo Milton Friedman's concepts about some speculators lose money and get thrown out of the market. Okay, so the simplistic strategies that survive in the market are all people with a kill switch. Okay, so I have met many people who do simplistic technical analysis, who all have a kill switch, who say, look, I know that when the market is boring, I keep on doing this simple technical type thing, I do a simple trend following type thing. And when things get turbulent or I get some nonlinear type signals based on my recent losses, I back off. I pack my bags and I go home. So I'm just saying that we need to approach this phenomenon in a very different way. What has changed is the observability of simple strategies, not the creation of a new class of simple strategies.